Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to host an Easter special of macro investing with two distinguished capital markets experts, namely Chris Watling, CEO of Longview Economics, and Edmund Shing, CIO of BNP Paribas Wealth Management. So welcome, gents.
Hi, yeah, great to be here. Yeah,
well, I'll tell you, investors certainly need your help at the moment, guys, because we're all been sort of scratching our heads over the quarter one of the resilience of the consumer and the increases in equities. But as we look into sort of the rest of the year for 2023, we've got obviously central bank continue to tighten, exacerbated by the recent banking crisis. So maybe, Chris, you could give us a quick sort of $64 million sort of like, view of where you think equities, the economy and inflation will be for the rest of the year.
Yeah, I mean, it's fascinating, isn't it? It's a fascinating time. Someone suggested it was a bit like that waiting for Godot recession. And in fact, I don't think they quite understood the play, because my understanding is Godot never turns up, and their implication was he does turn up. But the point is, it's a bit like that. We've been waiting. The yield curve inverted in the middle of last year, or arguably a little bit earlier than that, and people get impatient. But these things take time. And I think what's fascinating about the last month is the tight money is working its way through the system. And we saw that with the banking crises. These were not one-off events due to bad regulation. They may be the edge of the guys that are going to go first because they're the least well run, but they're a reflection of the fact that M2 money supply is contracting. And that has never happened in the lifetime of anyone on this call. And I should think 95% of the people listening to this call, it hasn't happened since the 1930s. And it happened a lot before then. And I know the structure of banking's changed and deposit insurance has come in and things like that. But the point is, whenever M2 contracted in those days, you had a banking crisis. And it's contracting again for the first time, as I say, in 80 or 90 years. And it's telling you that money's too tight. And that's working its way through the system. And the challenges are coming. And they're coming pretty thick and fast down the track. So I wouldn't be too quick to jump on the fact that markets have rallied and get too excited about that. It's nice to be involved in a rally, absolutely. And of course, the Fed provides liquidity. That's what they did in the middle of March. They expanded their balance sheet by 400 billion, pretty short shrift. And equities moved as a result. But this is not a liquidity problem. This is a solvency issue and a recessionary issue. And that's what markets are eventually going to get to price in. So I'd say for the rest of 2023, yes, enjoy April. But really, I'd be primarily cautious. And the place to make money is defensive assets. That's the place to put your money, basically.
Okay, well, we'll come on to that in a moment. I think Edwin and I looks a bit younger than we actually are. But Edwin, just turning to you, what's your view of the sort of the equities and the economy going forward? So last time we spoke, you were pretty positive.
Yeah, I am pretty positive, but that doesn't mean I disagree completely with Chris. I mean, I would still expect a recession in the US by the end of this year, for instance. I think that's pretty nailed on. But look, I mean, Chris is an economist. I'm not an economist, so I always have arguments with economists. I'm sure Chris, we probably won't have an argument actually, because I always say, well, what is a real recession? Because we talk about the 1930s, that was a real recession. 2008, a real recession. But a real recession is where you see blood in the streets, i.e., you see lots of companies going bankrupt, ceasing business, and unemployment surging, and real pain being felt in companies and in households. So the real question is, to what extent are we going to feel that sort of, that element of pain? And I think we'll feel a little bit of it, but I'm not sure it's going to be, I'm not sure it's going to be monumental. So we're going for a bit more of a recession, but not what I would call a real recession, a really, really painful period of time for economies and for households. So it's a little bit different. And I think part of that is because we are living in we have been through some very strange times. Let's not forget that, zero interest rates or negative interest rates. What was that about? That is bizarre. We've never had that in history, so I'm sure.
We had negative oil as well, didn't we?
We had negative oil, and then of course we had COVID. So we literally had the economy, large parts of the global economy, just shutting down, going to zero for a period of time. Everyone panicking, and then all the authorities and central banks and governments just throwing everything at the problem. You know.
So looking at that, if you reckon, you know, your words, it's nailed on for recession, and unfortunately I'm a reluctant bear, and I think I've probably got to join in the party here. But if you're right there, Edmund, what does that mean for S&P 500 EPS expectations? Because just to recap for investors, I think we're looking at about 220 per share for 2023, which is just about flat on last year. But we're then looking for 12% growth for 2024. What's your sort of like view? That it just seems.
I think both are a little bit on the optimistic side. I mean, I must admit, look, even though I have an overall positive equity view, I'm actually not positive on US equities. I'm neutral, and neutral at best. So I'd be pretty cautious on US equities for choice. And there are several reasons for that. Firstly, okay, we can talk about valuation, but that's not the real reason. The real reason is earnings, it's profit margins. And as Chris pointed out, look, we're going to have a recession. Profit margins are coming off an all-time high. It's very unlikely that they can stay anywhere in an all-time high. And by the way, they are falling. For many sectors in the US stock market, profit margins are falling. And what I find a little bit puzzling is, let's say you look at the S&P 500 performance this year, and it is positive. 2 quarters in a row, US equities have been positive, but the performance has come from a very, very select band of stocks. It is the usual suspects, Microsoft and Amazon and Tesla, and these guys have led the advance, but actually most of the rest of the US stock market has done not very much. It hasn't really
I think quarter 4 actually was negative in the US. And it's projected to be negative in Q1 of about 6%. So
in terms of earnings.
In terms of earnings, yeah.
Yes, that's right. Because you have this contraction profit margins going on. So even if revenues grow, and don't forget revenues grow because they're growing in, let's say, energy companies, right? But energy companies, as a proportion of market cap, are still a very small part of the S&P. Yeah. It's not like 20 years ago or so. You know,
you got to be
lump today. It isn't.
It's interesting. We did a little study of why margins are so high, because the sort of standard comment is, well, it's because of tech companies like you say, Microsoft and the like. But if you split it down into sectors across a broad US market index, over 50% of sectors had record profit margins in the last 12, 18 months. In other words, it's not just tech, it's not just energy, it's across a range of sectors. And most of the remaining 50% who didn't have record high had cyclical high. So this is the point. I think one big question is, how deep will the recession be? Edmund's obviously on the more tame side.
How deep do you reckon it's going to be then, Chris?
Well, I just think the consensus is, if we're going to have a recession, it's going to be shallow. But I think there are real risks that it could be much deeper than people think, because we are basically unwinding 15 years of financial repression and 15 years of zero interest rates. And we've built up a whole stack of problems as a result of that we're now starting to address very quickly, really. If you think about it, the rate that interest rates went up was extraordinary. And we're now seeing the problems. So I think you've got record high margins. You've got a PE ratio on the S&P 500 that is really, other than a bubble, it doesn't really get higher.
It's 18 at the moment, isn't it?
Exactly. You've got to be in a bubble really to get it much higher than this. So it's a record high PE ratio in normal times, record high margins, and earnings that haven't adjusted. And then a debate about, well, how deep should the recession be? And on top of that, there's all these other issues about unwinding basically one-sided asset allocation for 15 years. That's what financial repression is. Push everyone into equities, push them into risky stuff, and don't have a balanced portfolio. That's what's so fascinating about this banking crisis, because everyone thinks, as I said, it's one-off. Silicon Valley Bank or Signature Bank's got some funny things going on. But in reality, deposits have been leaving the US banking system for 12 months because Tina's dead. There's somewhere else to put it. Stick it in a money market fund, get 5%. It invests in government securities and park the money at the Fed and get 4%, instead of investing in a stock market, which has got a sort of earnings yield of about 5% and change. So it's a very attractive option. And we're getting reallocation of asset allocation, normal asset allocation coming back. And that's a real issue, I think, for the stock market, particularly when it's so expensive.
Well, one thing, though, it has been surprising in Q1, the strength, given the sort of the macro fundamentals have been sort of like, known, other than obviously the banking crisis, but it's sort of like been known for some time. So Edmund, in terms of sort of like, the thesis, the more bullish thesis, most investors are sort of like saying, well, the Fed's going to come to the rescue. It's going to sort of like, reduce interest rates and start printing money again. I mean, what's the likelihood of that?
Well, I do think QE is very likely. I don't know when, but I think it's very likely. I think my argument would be that quantitative tightening, or the reduction of the balance sheet of the Fed, their attempt to take money back out of the system, having injected so much, I think it's over already. I think the banking stress has put an end to it already. They won't admit it, but I think what they'll, as Chris pointed out, they've had to inject 400 billion back in. So in theory, they've unwound several months. I forget how many months it is. It's 6 to 9 months. It's a number of months of
3 or 4, yeah.
3 or 4 months of balance sheet reduction in a couple of weeks. So they blinked. I think it's quite clear that they blinked. Now, of course, they may stay on hold until the rest of the year. If you look at interest rate futures markets, the interest rate futures market disagrees and says, no, they're going to cut rates. But I'm persuaded that when you look at the interest rate futures market today, what it's predicting for Fed funds going out in terms of, so US interest rates going out into the rest of this year and forward, I think it's wrong. The only question is, which way is it wrong? It's either forecasting not enough interest rate cuts if you're going to get a deep recession of the style that Chris is talking about, and they're going to need to cut by a lot more than the market's forecasting in the next 6 to 12 months, because the smelly stuff hits the fan, and it's going to be all hands to the pump, basically, to help the economy out. Or the economy is more resilient than we expect. The banking crisis isn't as dramatic, but then why would they cut interest rates at all this year?
Yeah.
So either way, the interest rate futures market is wrong. Okay, you could argue it's pricing, it's doing some sort of probabilistic pricing. It's sort of pricing 50% one scenario, 50% the other. It ends up uncomfortably somewhere in the middle. Yeah. But I reckon the middle's precisely wrong.
Yeah. So Chris, what's your view in sort of like the chances that you've got effectively the Jerome Powell put, the Fed's going to bail us out, and we're going to reduce that sort of like the cost of capital, etc., as that will be then supportive of equities.
Well, I'd love that. That would be wonderful. I mean, that would be wonderful.
You think that's cloud cuckoo land?
Well, I think we've passed that point. I mean, it strikes me there's a couple of things worth observing and pointing out here, and I think personally, I think I'm a bit less optimistic perhaps on QT as Edmund is. I think the Fed is really following the Bank of England's playbook from the LDI crisis, which is basically create money and buy gilts for a few weeks and then go back to what they were doing. And what we really have here is we have the problems of trying to deal with monetary policy and financial stability at the same time. And it's essentially impossible. Because if they don't shrink the balance sheet and do QT, they're going to struggle to contend with and deal with inflation. If they do shrink the balance sheet and leave interest rates at high levels, they're going to get more problems in the financial system and more financial instability. So I think that's the Fed's dilemma. I mean, Rubini called it a trilemma because you chuck in the idea of you need a severe recession to clean the system out. But I mean, I think, I think it's very difficult. I wouldn't want to be at the Fed, frankly. I think they've got an impossible task. And I wish them luck.
Yes, but basically caught between a rock and a hard place. Chris, what is the sort of like the sort of fair value then? For what would you see as the fair value for the S&P 500? Because I know we talked about this at Christmas, and it was sub 3,000. I think you gave me a figure.
Yeah. Well, I think that's where fair value is. I mean, pool earnings $200, or maybe a bit lower. You can definitely make an argument for lower, and then chuck a 15 multiple on, which is the average. There's no reason why you should go the average or shouldn't go the average or lower. You get to 3,000, 15 times 200 is pretty easy. And if you look at what margins normally do in recessions, they don't normally come off a bit. They normally come off a lot. So I think, that strikes us as, I mean, you can make arguments for much lower than that, but there's no need to be too dramatic.
Yeah, okay. And when would be the point to get back in then? As in, like, to start loading the truck up?
Well, I'm not a fan of having levels to get back in. You have to look at behavior and the way the economy is evolving. Normally in bear markets that have a recession in them, you're looking for the indicators to start troughing properly once the recession's got going. So I think that's the trick, is looking at that sort of stuff. By then, you've normally cut a lot. The Fed's cut an awful long way. And by the way, if you look at the history of when the Fed's hiked aggressively, almost back to your question about what's the Fed funds futures market saying, almost every time without fail, it cuts aggressively afterwards. No, I'm not talking about when they hike once or twice. I'm talking about when they hike a lot, which is what they've done this time. So I would bet that the Fed funds futures market is wrong in that it's not pricing enough cuts. And when you buy this market again is really when you get into the recession and they've started doing the cuts and they're starting to address the problem of financial instability and so on. So, yeah, I think it's pretty interesting. If you look at M2 money supply, it is telling you that we're going to get deflation. Never mind getting rid of inflation.
Yeah. So Edmund, what's your sort of like your fair value for the S&P 500? Or
don't do that. Don't do that.
Okay. Well, what about sort of like your view for 2024?
Very sensible.
2024 earnings? Because let's just say, for instance, we don't really know what it's going to be like 2023. We've either got a mild recession, a hard recession, or possibly a soft landing, but nobody can really get their head around that on a fundamentals basis. But looking through the lens into next year is really going to drive where the S&P or the markets are going to go.
Yeah, I think with the S&P, earnings are going to struggle to make much headway, obviously. I think they go down and then maybe they go back up a little bit next year. But either way, from where we are today, not much change if you're lucky. I would say the earnings outlook is probably better outside of the US. I think we shouldn't just focus on the US. Even if the MSCI World Index is 60-odd%, more than 60% weighted to the US today, I think that's an anomaly. Just like the 50% weighting to the Japanese market in the late 80s was an anomaly for the World Index. We should see swing back to World ex-US. That's where we're putting our faith for the longer term for our investors, our clients. And so I would say, look to Europe, UK, emerging markets. These are the places. Even Japan. Japan has got some amazing value if you dig underneath and dig deep. But everyone ignores Japan these days. They just say it's irrelevant. Well, maybe not. And that's where I would be looking. And on that basis, I think earnings in many of these regions can actually grow. Where the US will struggle because you haven't had this explosion profit margins in Europe, in the UK, in Japan, or in emerging markets that you've had in the US. You just haven't had it. And companies have been very quietly raising profit margins, admittedly off the back of inflation. They've been a bit cheeky. They've used inflation as a sort of cover to raise prices more than they needed to cover input costs by, i.e. they're making a little bit of extra profit. And the ECB have actually pointed at that and said one of the sources of inflation is companies being greedy. And that's true. When you hear about Nestle and Unilever asking prices by 14% for their products over the last year, there's no way their input costs have gone up 14%. They're taking a mickey. Right, they're taking a mickey, passing through a bit of extra so they can make a bit more money, which is bad for us, but I guess for them, obviously in profitability terms, it's somewhat better.
Well, surely they're doing what companies are supposed to do. They're trying to maximize profits.
No, you're right, and I think Chris, honestly, consumers are a bit stupid, right?
No,
but they react.
I'm one of those. I'm one of those.
Well, I'm not. I actually experience physical disgust when I go to the supermarket now. I look at the prices. You've got to be kidding me.
Yeah, I know. I must admit, my box of PG tips has definitely gone up. That's for sure. Over the last year.
Well, you know what, Paul? In the end, consumers vote with their feet, and it's happening. If you look at the market share of Aldi and little discount retailers, they're going through the roof because people are sick and tired of it, saying, you know what? Stuff Nestle, stuff Unilever brands. I'm happy with Lidl's brand. I'm happy with Aldi's brand.
Yeah.
Right. And that's happening not just that's happening all across the middle class segment as well as everywhere else. So,
No, I would agree. People are changing behavior. Now, just sort of switching gears into an area that has really been hit hard and might offer opportunities. But you're the expert on this one, Edmund. And apart from sort of obviously BNP Paribas, what about the banking sector? It's a sort of like a bit of a hotspot in the US, particularly, and was in Switzerland with Credit Suisse. What's your sort of view there? Is that sort of like a no touch, or is there opportunities for the right stocks?
I think there will be opportunities in Europe in particular, but you've got to be selective. And so a few rules of thumb: don't touch the US, don't touch investment banking as far as you can, and stay with the most boring style of banking possible.
Lloyd's.
Right? So retail banking. Yeah, no, seriously. You know, one thing about Lloyd's and NatWest, they've been de-risked so much by force, by the US regulator, by the US government, by the UK regulator and UK government, that they're toothless. But that's what you want. You want a boring, toothless bank. You don't want something with sexy little bits and pieces inside, because that's the problem. And there's a reason why Terry Smith, who was a former bank analyst, doesn't invest in banks. He says they're just too complicated. They're like black boxes. You have no idea when something can blow up. Because you have no idea how they really, really work. And this is one of the problems of companies like Credit Suisse. They always had things that blew up, but you didn't even know, in activities you didn't even know they did.
Yeah.
Right? And that's the scary bit. So I'd say stick with really boring stuff. But I would actually go further than that. I'd say, look at the collateral damage of banks, the bank collapse. And I would say look at insurance companies, look at leasing companies, maybe look at selective real estate investment trusts, because they've all been hit very hard by the sort of fallout from the banking stress, and in many cases have suffered just as much, and yet their business models are not as tied to
what about
deposits, for instance.
I'm going to ask you a tough question here, Edmund. Apologies. What about AT1 bonds?
Well, I would say they are interesting for the very dynamic investor. First of all, you need your tolerance for risk to be right on the ceiling. Okay, so no, honestly, for 95% of investors, it's a no-no.
Yeah.
Because do they even understand what it is? Rule number one: if you don't understand the investment, don't touch it.
Yeah.
Right? You need to understand what you're investing in. So if you can be bothered to go through what an AT1 cocoa bond actually is, and you can be bothered to look at the differences between the UK ones, the continental European ones, and the Swiss ones, and you can understand why Credit Suisse and UBS are apart from, they're different from, and they are substantially different from. They were allowed for these permanent write-downs, which is not allowed according to the prospectuses of AT1 bonds in continental Europe or the UK. But even between the UK and continental Europe, the type of write-down that happens in the event of a sort of a trigger event, which is the bank's equity capital going below a certain level, again, it's different.
Yeah.
You either get converted to equity, like in the UK, you get converted from bond into you become an equity shareholder when you didn't want to be, or you get a temporary write-down, i.e. they suspend coupons in the continental. And it's this sort of level of detail you need to understand before you invest in this stuff.
Yeah, the devil's in the detail in that prospectus.
Absolutely.
Yeah, very good advice. Very good advice.
Chris, just turn into the sort of the text. Now, one real, again, surprise has this been sort of safe haven trade into sort of like the cashed up monopolies of sort of like, Apple and Microsoft, and obviously sort of like juiced up by sort of the Tesla and also regenerative AI for NVIDIA and stuff like this. But these guys now are sort of trading at sort of like high octane levels. What's your sort of review of that sort of like the safe haven trade? Is that got too many legs?
So I wouldn't. I think I'm not sure it's really a safe haven trade. I think it's a liquidity trade. I mean, that's what we've seen. It's I think it's liquidity been driving certainly the last leg, and also they were deeply oversold, much unloved. And then, of course, earlier this year, we had that whole idea that retail traders were doing their sort of 2-day options trading in them. I think it's ODTP or something like that, or 1-day options, and that pushed them up. I think this is, these guys were, they were the heart of the bubble coming into 2022. And I don't think they finished unwinding that excess. And actually, back to Edmund's earlier point, I think if you're thinking long term, in terms of equity markets, the US is the place to avoid, because that is the place with the very rich tech valuations and the very tech-heavy, tech-centric stock market and tech and growth stocks. And if you look at the global IT sector, it's more expensive relative to the rest of the world than it was at the start of 2022. So it's richly priced.
Yeah, Nasdaq's on, just for investors, I think Nasdaq's on 25 times.
Yeah, I think, if you look at the TMT bubble, it actually took 14 years for that bubble to unwind fully in terms of a relative valuation. Much of the heavy lifting was done in the first 2 or 3 years, but But you know, I always say markets have fashions. You know, one rule of investing, just to add to the wonderful list we've already had. But I'd say one is markets have fashions, and don't get caught up in the latest fashion. And in bear markets, the fashion always changes and the leadership changes. And I think that's what we're going to see in terms of tech. Tech's been leading for 5 or 6 years, and really it's just had a flurry for a few months. I wouldn't get too caught up in that. I think it's not going to lead this market in the next few years. Non-US markets are going to lead it. So if you want to think of 2023, if you want to think about the opportunities in 2023, I would say use weakness and sell-offs into recession and times like that to build your portfolio on a 3 to 5 year basis, and think in terms of non-US assets on that time frame.
Yeah, another one which is sort of like, you know, sort of building your portfolio as a potential upside here, Edmund, and I'd be interested to hear your thoughts, is if we do, I know it's just long shot, but if we do get a resolution to the Ukraine sort of crisis, get a ceasefire, because I know the allies are sort of like, you know, sort of ingling that, you know, that hopefully there'll be some sort of resolution. And I know China's sort of stretching out an olive branch in terms of trying to bring the parties together. But if you did get that, what would that do for the markets, and particularly, say, oil and defense stocks?
Well, that's a very good question. I mean, personally, I don't see that in the near term. But one can always be surprised. You know, no one saw the banking crisis coming so quickly. No one saw COVID coming. So who knows? Personally, I'm a little bit skeptical, but there is a possibility, absolutely. And maybe the possibility comes from the fact that Russia itself is not really making any advances. It's costing a lot in terms of equipment and men, but what is it actually gaining? Not very much. Maybe they will be forced to the table at some point sooner rather than later, because the cost becomes too great. At a time when sanctions are actually really starting to bite. You look at Urals blend oil; it's priced at something like 47. Recently, it was priced at $47 a barrel. Well, that's not great news for them. And their strategic profitability in terms of natural gas sales to Europe, obviously, was fantastic last year. But look where gas prices are now. That is ebbing away very, very quickly. So that economic boost that they had is disappearing. And I think that's also going to put more pressure on the Russian regime. But if all of that were to happen, you would think oil prices would come down. I'm not so sure, because in what world would the West relieve or release the sanctions on Russia? I don't see it.
Well, what about oil stocks, though? Oil stocks would come down, even if they didn't in the short term, simply because they'd price in, because you price the oil stock over sort of like a longer period, it would price in the oil price, you know, decreasing in year 3 or 4.
Why? But why, Paul? Why?
Do you simply because if Putin was forced basically as part of the solution to step aside.
Well,
no. Most of the Russian oil's getting out. I mean, I think the reality is it's getting out. It's all coming out in tankers. There's more oil coming out in tankers now than there was before the war.
Exactly. How would you explain the oil price being so low up until the recent quota cut? I mean, I completely
it's not a tight market. The reason the Saudis cut this week is because it's not a tight market, and the Americans refused to buy for the SPR, which they thought they would be doing. So the whole world's geopolitics has changed completely. It's utterly fascinating. The Saudis, we know, basically switched sides and got into bed with the Iranians, brokered by the Chinese. This is an extraordinary geopolitical event, isn't it? Really.
It's quite quiet, actually, because we've had so much of the other sort of like news flow that's sort of like gone under the table, hasn't it?
But that is monumental. That is monumental when you think about it. When you think about the equity they've held for so long.
So Chris, what's your view on the sort of the oil market then? I mean, if you're both saying then actually $70 is a floor because we've got OPEC coming in, you know, to basically hold that, then it's going to be sort of like, you know, gangbuster times for the energy stocks, and they've sold off surprisingly in Q1.
Yeah, I don't think $70 is the floor. I think that's just a bounce on the back of the deal. I mean, it looks to us that it goes lower. In recessions, oil demand falls a lot because, of course, America is the big demand engine. So, yeah, I think it goes lower from here. But having said that, buy energy assets when the oil price sells off for all the long-term reasons that we all know about. No one's really looking for it, and et cetera, et cetera. There's long-term supply issues, and the geopolitics adds to that. So You definitely want some of that in your portfolio. But yeah, but just don't be hasty.
And
don't be hasty.
What about currencies, Chris? In terms of is the dollar? Everybody's been sort of like talking the dollar's going to weaken, and it has a touch, but frankly, against sterling, I mean, we're not exactly the sort of the strength around the world, really, or the euro, in fact. I don't think.
Yeah, there's a lot going on in the dollar, isn't there? Everyone's getting very worked up about this idea that Russia's selling oil in renminbi and yuan and all that sort of stuff. And I mean, if you look at how much of the Chinese currency is in international trade, the number is trivial. People talked about the demise of the dollar as reserve currency forever. It's going to happen, and there's lots of issues. I don't disagree with that, but I don't think it's immediate. And really, what happens is when you price in risk aversion recessions, the dollar rallies. So I would say there's another rally in the dollar, and it rallies because the dollar availability tightens up in recessions and in tough times, and I think that'll happen again. So. Yeah, I think it's sort of noise. I mean, people forget the Chinese economy is not that strong. I don't think it's got huge structural issues. I mean, we wrote a piece about it a couple of years ago, how it's the next Japan. It's got everything Japan had in 1989, really, pretty much, apart from a sort of stock market at sort of crazy PE ratios. It's got the rest of it: housing, debt, a crazy banking system. Lack of real productivity growth, overinvestment. I mean, it's a long, long list, and terrible demographics. So I'm not so convinced that the renminbi is the next thing the dollar's done. But cyclically, rally in the dollar, and then you probably want to go for other currencies, I would have thought. But that's just a cyclical view.
Yeah. Well, I mean, there's plenty of things that could sort of like blow that one to pieces. I suppose if China decides to invade Taiwan, that would be a major issue for their currency. Now, let's move to stuff that we obviously, areas that we quite like. And I think one consistent area for both of you is precious metals. So Edmund, I know you've sort of like highlighted sort of silver or potentially that area.
Yeah, well, gold and silver for the obvious reasons. I mean, Chris has mentioned some of them. If you're thinking about safe havens, the dollar, yes, it sort of is, but at the same time, central banks around the world are looking to diversify out of just the dollar. And to your point, what other currencies you want to hold reserves in? Sterling? No, thank you.
Yeah.
Yen? No, thank you. Definitely
Bitcoin?
not.
Bitcoin? It's up 70% in Q1.
Yeah, well,
Bitcoin.
Yes, well. The digital store of value argument, I remain to be convinced by.
Yeah, same here.
So I think you do fall back on gold because it has been a store of value for thousands of years. It does act as an alternative currency, and it's probably, I mean, when you look at the ugly sisters, it's probably one of the least ugly of the sisters for banks to hold as reserves, central banks. So I like that story. I actually do think the dollar trends lower, not hugely low, but a bit lower, because I think again, the Fed's going to have to cut rates, and that's going to start to undermine that source of appeal for the US dollar, and also the terms of trade. Let's not forget, as energy prices come down in Europe, the terms of trade are not as favourable for Europeans buying oil from the US. Remember, they buy a lot of LNG from the US, but the terms of trade are going to be a bit less unfavorable for Europe and for the euro going forward. So I can see euro dollar moving a little bit more in favor of the euro, and that again should help the dollar. But more importantly, long-term interest rates coming down is a big support for the dollar. So again, look, there are two ways long-term interest rates can come down. We can either get the deep recession that Chris is expecting, which should bring long-term interest rates lower, right?
Yeah.
Bond yields should come down, or you get more financial repression, which I suspect is going to happen. Because central banks are going to try to kick the can a bit further down the road, but that also will probably lead to stable to lower bond yields, and again, that's relatively supportive for gold. And the reason I like silver is it has industrial uses like solar panels and electronics, and the solar panel demand, I think in particular, is growing and is going to continue to grow because, believe it or not, in economic terms, but the energy transition is going to happen, right? There is the political will there. The money's being put to work in the US and in Europe. It's going to, that's going to accelerate, whether you think that's a good thing or not. And that's going to help the industrial demand for silver. And silver today is at $24. It's half less than half of its 2011 high, at a time when gold is back to and breaching pretty much a new all-time high.
Yeah.
So
So
it's
how do you
massively.
invest in that then, Edmund? Do you go through the stocks or the miners, or do you go through actually a sort of like an ETF physically
Yeah,
backed?
you can do both. I mean, I would say you can start with the ETFs for physical, but make sure it's physical
Yeah. Okay.
gold, physical silver. That's the sort of the bedrock, and then you can also diversify into miners as well. The problem with miners is that you've always got to watch their costs, because again, you can have problems with salaries, you can have problems with energy cost, because of course mining is very energy intensive. And the third point, you always have to look at the geopolitical risk. As in,
Yes.
where is the mine?
Yeah.
You know?
Exactly. Yeah.
So I'm always a big fan of geopolitically stable jurisdictions, so Canada, US, Western Europe. Not so keen on some South American countries are okay, but you've got to pick and choose, because some are definitely not okay and can change in a blink of an eye in geopolitical terms. So one has to be careful. But I think I go for those producers who are those companies that are producing today. Secondly, that are cash rich. They have cash, not debt, on the balance sheet, and showing good, strong cash flow returns. So again, good discipline in terms of capital, which is always the problem with mining companies. In the past, they've always done stupid things, overinvested at the top of the cycle and killed the cycle. Now, there is a good evidence that mining companies are not doing that today, but I would certainly be looking for those precious metals miners that are showing good, strong capital discipline.
And which ones are like, I don't know, was it Fresno or Randgold or?
Yeah, I mean, you don't have a lot of choice with silver miners in the UK. You've only got two of any size. Okay, so Fresno is one of them. Okay, it's okay. It's not my favorite, but it's okay. I would look more to Canada if you can do that. But then, of course, you have all the problems with international stocks.
Yeah. Okay.
Which is one reason why maybe it's easier to go for an ETF, because then you get that geographical diversification through one fund. In the UK, if you look at smaller gold miners, there are names that are interesting, with Caledonia Mining. Now, that is in Zimbabwe, but actually it's on the South African border, and the management have shown themselves to be extremely capable and very good at risk and capital management over time, and that's a very cash generative business, and they've kept the all-in sustaining cost of gold production pretty low. And so that would be one. What was the other one? There was one other. Oh, the other thing I would mention would be royalty companies. Because royalty companies are a way of getting exposure to the oil price and oil production without taking all the risk of the costs.
Yeah.
So basically, they provide financing to mining companies in return for production, a share of that production.
Duke royalties, I think, is one, isn't it, or something?
They do that, but they're not in commodities.
Okay, fine.
So I'm thinking you could look at Trident royalties, which is a small one, or Ecora is another one. It used to be called Anglo-Pacific, I think, and now they just changed their name. In the US, the two big ones, in North America, the two big ones are Franco-Nevada for gold and Wheaton Precious Metals for silver, and those have outperformed gold and silver miners by a long way over the long term. I think that's because their business models are a little bit, they're de-risked compared to the
Okay, good. Well, that gives investors a lot to chew over. Now, Chris, just turning sort of like to sort of like the all things sovereign debt. I know you quite like sort of the US, UK, and even potentially going long on European sovereign debt. Do you want to take us through that one? What's the thesis, and sort of like, is it defensive nature, I guess?
Yeah, I mean, if you look at sovereign debt, I mean, a lot of key asset classes in the world. I mean, it's another sort of a rough good rule of thumb, tend to have sort of 2.5, 3-year cycles. And if you think about US government debt, it yielded almost zero in August 2020 and March 2020 in the depths of the pandemic. We remember the sort of bonds rallied hard, the yield sold off to really low levels. And basically that yield's been going up for 2.5, 3 years. And so, there's a very rich yield. It looks to me, if you look at money supply, the inflation is going to go pretty fast over the next 12 months. And so you're left with actually an attractive real asset that you can put money into that is a very good hedge against recession. Of course, bonds normally rally in recession, and gives you a good sort of coupon along the way. So it's got a lot to be said for it, I think, and it's very defensive. And I mean, I think it's interesting.
It's 3.5%, isn't it? The 10 years about 3.5%, I think, in the States.
Yeah, I mean, it's that sort of level, exactly 3.5%, 4%, 4, I forget, is it 3? Yes, I'm having a senior moment now, but it's that sort of level, exactly. It's a lot up from zero. Let's put it.
Yeah, I know. Yeah, no, exactly. Now, how come you've decided to you prefer the longer duration to the shorter term? Because it's about 4% or 4.1% for 2 year, and obviously US interest rates currently are at about, I think it's about 4.75 or something like that.
Yeah, it's about the idea that if we get a recession and yields come off, you get capital appreciation at the longer duration government bonds as well. So the price goes up more than it would at the shorter end, basically. So you get the yield plus you get price appreciation. So you get a kind of double whammy the further out you go. If you go very short dated, you don't get the price appreciation.
Yeah. And what about corporate debt, given the spreads and sort of like what's baked in there into in sort of like, I don't know, in IG and high yield?
Well, it's kind of less attractive. I mean, the IG maybe a bit, but high yield definitely not. It's not pricing in a recession. It's not the sort of level you'd expect of sort of 1,000 basis points spread, say, we're at about 400 or 500 odd.
Yeah.
And, you know, if we're right about the zombies, all this corporate bankruptcy risk and the banking system, then you've got some real challenges and you may well see those spreads blow out quite a lot. So I wouldn't jump on those here. You might want to buy them in blowouts, but I don't think we're quite there yet.
Stick to basically the sovereign side, remove that credit risk.
It's quite a boring asset allocation in some ways. It's just very defensive, very safe. But, you know, sometimes you have to have that. That's not what you normally have. But, you know, sometimes you've got to go with the flow. Yeah,
hey, I've got 30% of my portfolio in cash. So if I can get a better return, then I will. In fact, I might move into a money market fund. It would probably make sense. Now, Edmund, just in terms of sort of like, I know you quite like the CAC 40, don't you? The sort of like as that for an index. I guess it's probably done quite well because it's populated by a bunch of luxury brands and sort of like L'Oreal's and LVMH's, this sort of stuff with the Chinese reopen. But do you want to take us through that one?
Yeah, so basically the idea is if you look at the CAC 40 index, it's quite unusual in the sense that if you look at the weighting of banks, such as my bank, for instance, it's not that big. It's less than 10% of the index, first of all. And yet 30% of the index, as you say, is branded goods, whether that be cosmetics with L'Oreal, whether it be the classic leatherware like LVMH, you know, leatherware and watches, or if you think about drinks, you think about Pernod Ricard. If you put those three lumps together and say they're all branded goods, you're at 30% of the index, which is a very high proportion. And again, as Chris will know, things like cosmetics and drinks tend to be quite recession-proof. In other words, in fact, they're sort of counter-cyclical. You go and buy a drink. You buy a drink because you feel a bit depressed, or you know, you might put your wife might buy some cosmetics because she needs to cheer herself up a bit. And so this actually is quite counter-cyclical, very resistant. And on top of that, companies like L'Oreal are amazing in that they can maintain profit margins simply by shaving 1 or 2% off their marketing costs for a couple of quarters. And given that they spend, I think it's 20%. It's at least 20%, might even be 30% of sales on marketing costs. I mean, they just spend.
It gives them a good buffer.
It gives them a very good buffer. They just need to shave a little bit off that advertising budget, and they can maintain margins quite happily. And
what are they priced on? Are they quite expensive, L'Oreal?
Of course, yes.
Quite
expensive. They're expected to 10
stock.
times earnings. They'll be 20 times plus. They won't be cheap, but they are. Unlike the US tech companies, I would argue they are much more truly defensive.
Well, they've certainly been shaving the size of their bottles off. There's no doubt about it. They've had shrinkflation, no doubt about it.
Oh yes.
What about just continuing that sort of like the French theme? I know you quite like AXA, the insurers, don't you? Now, my question, I think a lot of questions from investors: what's the difference between a bank with the black box and an insurer black box?
Well, I sometimes think the insurance business model, in most cases, is much simpler. In the sense that, let's say,
do you?
Yeah,
you're obviously a better analyst than I am.
No. In terms of the simple drivers, so the simple drivers. Look, there are two. Let's keep it simple. Two legs to insurance. There is the property and casualty insurance. I need to insure my car. I need to insure my house. Okay. Guess what? They're crooks. Okay. Let's put it simply. They're crooks. They put the premiums up every single year, and most people are too lazy to shop around and change, and that's actually more true in continental Europe than in the UK. In the UK, consumers are actually quite good at shopping around and getting a better deal on their insurance. You know, comparison websites, everyone uses them. Not in continental Europe. People are much, stickier. Which is great if you're someone like AXA, because it means that you just jack the prices up 5 or 8% every year. No one seems that they might have a little moan, but nothing happens. They just pay.
I think the valuation on the insurers is pretty good as well, isn't it? Because they have been caught up in this whole banking side. So I don't think they're not trading at rich valuation multiples, certainly not net tangible assets.
And the life insurance part is really a savings product story, and that benefits from higher bond yields, right? Because higher bond yields means, because what they do is they back their savings products by buying bonds. So if the bond yields are higher, they can offer a higher income yield to the saver. That becomes more attractive. They get inflows, and that's the dynamic that's happening at the moment. So they benefit on the life insurance side from the higher bond yields. They benefit at the moment from the P&C side from the sort of inflation-linked increase in premium. And of course, all you need to make sure is you don't lose a fortune on the underwriting side, i.e., there's some sort of massive hurricane or a huge, massive storm where they get a whole wave of claims, and that's the one thing that can sink you as an insurer.
Well, that's what happened with Direct Line, doesn't it? Go on, Chris.
I was going to say, Edmund, I'm curious because there's this whole story that was doing the rounds about all the sort of European insurers offering annuity products over the last few years, when there was basically they were earning zilcho on their bond portfolio. So they were offering 4 or 5% yielding annuity products and having to pay for them. So surely they got a lot of bonds in there that are loss making in a big way. So the story kind of works both ways, doesn't it?
That's true. I mean, the problem is, Chris, you have to balance off the effect of the mark-to-market bond portfolio, which is, as I said, down, with the impact from the inflows, which benefits. And actually, so when you look at this historically for life insurers, the inflows tend to be more important for the valuation than the fact you've had a mark-to-market hit on the bond portfolio, funnily enough.
Right.
Yeah, statistically that has been the case.
But I can buy that statistically, but we would have said the same thing about the banks in the United States. Historically, it doesn't really matter what happens to their bond portfolios because they're never really realized until maturity. But this is a different. I mean, are there parallels? Are there any?
Not really, because I think that's only one side of the equation. With the US regional banks, there was that. That was one problem. But the real problem was the deposit flight, and the real problem with the deposit flight was, to be honest with you, I think most US banks were trying to be too greedy. They were taking risk on their bond portfolio they shouldn't have been taking. At least they should have hedged properly. And Silicon Valley Bank the worst part about Silicon Valley Bank, they did actually hedge out their bond portfolio, and then they decided, nah, we're not going to bother. We're going to take off the hedge. They actually and then took it off. I was like,
they didn't have the risk operator. They didn't have a risk manager.
No. I think they were missing a chief risk officer or something. Literally, didn't have a chief risk officer or something.
But what I'm curious about, Edmund, is what was bizarre last week in the States is as these CDS prices went up on Deutsche Bank and others, they started going up on some of the US insurers, which I thought was very strange. And I just wonder if there's something we're not thinking about in the market where there's a funny fish out there.
No, it's the commercial real estate risk, I think, because there is an exposure of, let's say, US insurers in particular, not just to bonds, but also commercial real estate. And there is a sort of a risk of contagion in that 70% of commercial real estate debt is financed by regional banks. So if they're tightening credit conditions, tightening up their loans, refinancing theoretically becomes more difficult for commercial real estate. Prices are dropping, particularly for office real estate, because at the same time, the return to work trend is not that strong in many American cities like Washington, D.C., Atlanta, and Dallas. So you have the combination of more expensive and more difficult debt to refinance and office vacancies running at a worryingly high rate because the return to work is not being very strong. And so but I think that's a little exaggerated, because when you look at commercial real estate in the US, less than 20% of a typical unlisted property fund is actually office real estate. So there's 80% which is other stuff, multifamily housing, it could be retail, it could be logistics, industrial, which are doing somewhat better than office. Office is the weak point. So I think that was the worry. I can understand it, but I think it's maybe a little bit exaggerated. And also, we shouldn't assume that commercial real estate all needs to get refinanced tomorrow.
It's a big refinance book coming up.
It's coming up, but it's coming up over the next few years. It's not all coming up tomorrow.
Well, there's quite a lot coming up this year, but it's not just commercial real estate, is it? I mean, it's industrial as well. If you start putting zombies out of business, you've got industrial issues.
Absolutely.
If you look at the, the apartments, the number of apartments that are being built in America, it's at 40-year highs, which suggests there's a problem coming there. I think it's just not quite as straightforward as that little issue here, there, and there's actually a whole number of issues that have been reflective of cheap money, I think, that
Absolutely.
could really, and actually, I don't see why it's not European. I think it's an interesting piece of analysis that has to be done. I mean, valuations on real estate is rich because money was cheap, and money's no longer cheap. So I think there's some real challenge. I just wonder if there's some of these insurance companies have got portfolios tucked away that are really under quite a lot of pressure. And I don't mean just the bonds, but also some real estate stuff and some private equity stuff, et cetera, et cetera.
Yeah, I think, well, what I would say about European insurers, without going into too much detail, Solvency II has severely limited their ability to take risk, especially in Europe. And I think in the US, I'm not so sure. I'm not an expert in US insurance, but in Europe, that has definitely been the case. And they had to de-risk their portfolios dramatically. And they are very heavily, they're very heavily in corporate bonds today. That's really the biggest exposure for these guys, more than anything else. For AXA and their life insurance businesses, it's nearly all corporate bonds. They've even had to like de-risk their real estate portfolio. They've actually been sort of like selling it off bit by bit over years. And they have very little equity exposure. So the real risk, if there is one, I think would be in the corporate bond side. But even there, they're not allowed to be in high yield. They have to be in investment grade because high yield, the risk cost on the Solvency II is extraordinary. And I think I would completely agree with you. The risk of zombie companies in Europe and in the US is very high, which is exactly, I would agree with you. High yield is a place not to be because you're going to find a lot of zombie companies sitting there who will at some point not be able to refinance themselves anymore. And then suddenly you're going to be hitting Chapter 11 pretty damn quickly.
Yeah, I think what's fascinating is the more you, the more you think about it, the more the market moves through this trade, the more bits and pieces become exposed to. They were the beneficiaries of funny money, and now funny money is unwinding. And it's not, we started thinking it was just a few meme stocks and a couple of cryptocurrencies, and then it was some small cap tech, and then it's big cap tech, and now it's commercial real estate, and then it's the bank. I mean, this is the point. It's an extraordinary everything bubble. And we're now facing quite a few challenges, I think. That's what's really interesting about this.
Yeah, I think you both raise fabulous points because it's certainly a potential, and I wouldn't class it as a black swan. I'd class it as a black duck because this is definitely, it's something we can see.
A black duck? Is there such a thing?
It was more common, isn't it?
A moorhen.
More common than a black swan. It's still rare, but more common. But I think you raise both really good points because you've got to know what your companies, your stocks particularly own on their balance sheets. And it's that devil in the detail that you talked about, Edmund, in terms of the, sort of the bonds for AT1s, but this whole global trend of funny, cheap money has meant that there's a lot of unrealized sort of like, cutting damage potentially on people's balance sheets. And that could be at the epicenter, could be the banks, and it could be the insurers, it could be private, sort of like private equity or whatever. And that hasn't yet really sort of like flowed through the system. So yeah, you've really got to be clued up on what you actually own, I think is probably the best thing. Now, Chris, just in terms of sort of industrials, this is another area that has really been done quite well, actually. And it's in terms of the likes of, I don't know, people like Honeywell and all these kind of guys. What's your sort of view on industrials? I'm guessing it's probably giving you a dire prediction. It's not something you're going to be buying soon.
No, I mean, they've done well, of course, and they're beneficiaries of the pandemic. They were beneficiaries of, some of them beneficiaries of war and all the fact that you've got to build a lot of weapons, all this sort of stuff. But if you look at them, they're very richly priced. And I think what's interesting is this is what they normally do into the start of recessions. They rally hard. People don't quite notice, and they become expensive relative to the market. So if you look at industrials today, they're trading quite a premium to the market PE ratio, and their earnings haven't really come off. There's this sense that there's a big backlog of orders, so they're fine. And so there's definitely been a bit of distortion by the pandemic, but I just don't think you get away with recession and not pricing in some challenges for these guys. And you just look at ISM manufacturing new orders. They've been very low for several months. And there's definitely lots of parts of the industrial space that are under quite a lot of pressure, housing, for example, as a classic example, really, or a lot of the goods. So I think clearly there's got to be some challenges there. I don't like the sector. I would avoid it. I'm sure there's bits and pieces within it that stock pickers can find that they like. But in general, I would be. I think they need to derate, and I think they need to get the earnings expectations down as well.
Yeah, I think there's going to be tough sledging, agreed, in that area. Now, Edmund, in terms of sort of like the semiconductors, they've done really well, surprisingly so, across the US and in Europe. I mean, you've got people like Infineon, which is up sort of like 50% as well in Europe. So what's your sort of latest on semis?
Well, I do like the sector. I think you have to be a little bit careful, of course, because some of the valuations are getting a bit monstrous. Like, I mean, everyone loves Nvidia, everyone loves AMD.
It's only 100 times earnings.
I know. I just can't get my head. I mean, they are. Again, this is where you could say it may be a great business, but is it a great investment? They don't always coincide. And when I see nosebleed valuations like that, I do get concerned. But I do like the sector in general. I think the reason that, if we think about, let's say, the trend in artificial intelligence, it's very difficult to know how that's going to play out, who the winner. I mean, I've got a doctorate in the stuff, and I still have no clue who's going to win. Really, it might be Google, it might be Microsoft, it could be any number of companies, and I'm not willing to bet because it's too early to know, frankly. Yeah. But one thing I can be pretty sure about is that the demand for processors, for memory, for storage, for sensors is going to continue to go north at a rate of knots. And I think as well, if we think about things like nearshoring and about the need for greater industrial automation, that's also going to add to the demand for chips. So either way, I see just secular growth in demand for all manner of chips, and that helps the semiconductor industry. Of course, then the European semi companies are doing quite well.
They're doing great. Yeah,
at the moment.
Yeah. So would you go into the chip designers and chip makers, or would you go into the equipment suppliers? Because what you seem to have is you've got this US, move strategically into chips and to build new capacity. You've got it in Europe, and it's going to happen in Asia as well. So you seem to have a large lot of supply coming on. Yes. And at some point in time, you're going to have lots of supply and maybe not quite the demand in sort of 2 or 3 years?
Yeah, maybe. I think it's going to take a while. I mean, I think in the commodity chips, you already do see a bit of a sort of short-term glut. Micron and Samsung have been talking about that. But I think that's more of a short-term inventory issue. I think longer-term, the equipment makers are still very well placed because if you listen to something like ASML, they just can't make their machines fast enough. They have 3 years of back orders, and that's not going to change tomorrow because they are a unique company. Simple as that.
Gotcha. Yeah, no, I think you're spot on. Now, I want to ask you a cheeky question here, Chris, because I know you like these cheeky questions. Just on pharma, what's your sort of like the healthcare? Because that came into the year on a strong footing and has actually sold off pretty hard. It's down 10, 15% in Q1. And actually, certainly big cap pharma is on, low T multiples for good pricing power.
You asking me or are you asking Edmund?
No, I'm asking you, Chris, because that was a cheeky question for you.
Well, look, I mean, it's a good question. I don't know. I'm not inclined to jump on them, but they tend to do better in defensive moves in the stock market. I'd rather have staples, to be honest, because there's all sorts of issues post-pandemic, pre-pandemic, pipelines of drugs or non-pipelines of drugs. I think you need an expert on that one.
Yeah. Okay. Fine.
That's me ducking the question.
No. It was a cheeky. It was definitely. I just threw it out. Now,
well, to be honest, sometimes we have views on farmers, but not at the moment, I guess is the answer.
Okay. Good. Well, now, Edmund, in terms of sort of like, over the next month, what do you reckon we should be looking out for in terms of sort of like, monitoring on the markets? Is it going to be sort of like the continued inflation data? We've got the Fed actually giving its latest interest rate on the 3rd of May.
Yeah, I'm not so worried about inflation. I think inflation's heading down. I think, if you look where energy prices are today, that's where inflation is going to be in a few months' time, which is a lot lower. I think food prices will start to unwind finally as well, because if you look at the FAO World Food Index, it's already down a lot, and yet in the supermarket I see zero evidence of even a flattening out of prices. So that's still to come. I guess the big question is going to be on salaries, wages, particularly the US and the UK as well. But of course, we all know UK is beset by particular issues relating to Brexit and immigration and so on. But if you look to the US, I'm pretty convinced that a lot of this wage pressure is going to ease, because I'm with Chris. I think it weakens. I think that all the forward indicators I look at are telling me that wage pressures are going to ease in the US quite substantially. Initial jobless claims start to go up. Companies are they're not hiring. They're just not hiring. You can see the job announcements falling off a cliff, and some of the big industries. We talk about tech. Finance obviously is going to be shedding jobs now. Construction, I think, will be also starting to lose jobs, and that's a big employment sector.
Yeah.
So when I look at it, I just don't see how wage growth can be maintained at that level, which means the price of services will ease. And don't forget, inflation is a year-on-year change thing. So, all you need is for things not to keep going up and up and up, and inflation will come down, mathematically. And I think that's sort of where we are.
Yeah, that'll certainly change a bit of sentiment. What are you looking at over the next month for, Chris? Is it going to be sort of like, we've got a jobs report actually this Friday, and obviously credit spreads, I don't know.
Yeah, I mean, tons of stuff. But I think what's really interesting is that manufacturing is clearly in a recession in the States and in much of the world. And what you see, this sort of divergence with the service sector and how that reconciles itself will be fascinating. So we've got ISM services, for example, out later this week in the States. And, it's had a bit of a bounce because of the weather, people say, or there's all kinds of theories why it's bounced in the last couple of months. So I think how that plays out will be fascinating, along with everything that Edmund mentions, what the Fed gets up to, whether they start doing QT again. So they dialed it right down in March during the banking crisis to low levels. And if they start picking that up, and then I think all eyes on the debt ceiling debate, because, when it's resolved, if it's resolved, which we all think it probably will be, there's a small percentage chance it won't be, but let's say it is, then they're going to start issuing debt. And that sucks market liquidity out from the equity market. So I think all these kind of things all need to be kept a close eye on. There's so much going on. I have to say, I was saying to someone the other day, I mean, I think in the last 5 or 6 years, there's been a crisis almost every year of some sort. So it's great business for economists and market strategists. So not necessarily good business for everyone else. Well, I think we're like lawyers. We're like lawyers. We do better in recessions.
Yeah, well, I'm hoping we don't get a major shock this year, but if it is, it'll be positive with a bit of luck, but we could always pray for that. Okay, well, thanks very much for your time, gents, and look forward in touching base in May.
Yep,
Thank you.
Look forward to it. Thank you,
Appreciate it.
Thank you, Chris.
All the best. Thank you. Thank you, Edmund.
Cheers.